What's up, financial time travelers? Welcome to episode 19, Common Misconceptions. Yes, y'all. Doop. I'm gonna get rid of this page. I'm not gonna throw it. I'm gonna be very neat today. Ready, Nick? Let's have a good time. Let's do it.
I'm not an investor. People always tell me, you should have your money working for you. I've decided I'll do the work. I'm gonna let the money relax. You know what I mean? Because you send your money out there working for you, a lot of times it gets fired. You go back there, what happened? I had my money, it was here, it was working for me. Yeah, I remember your money. Showing up late, taking time off.
Chuckle.
We had to let him go.
Chuckle. All right, guys, ready to blow your mind? Because it's about to happen. You ready? Explosion. You know when you do the fist bump and the explosion and you're like embarrassed that the person did it, but really deep down inside you thought it was cool, it never gets old? That's how I feel right now. Is about to blow your mind because technology, not trade regulations, killed manufacturing jobs. And this article, I'm going to cite my source, came from the Fat Pitch with a P. It's a blog spot of a guy who manages millions of dollars, and he writes really cool market commentary probably once every other month. He comes out with this really long form, great article that blows your mind. So let's get right into it.
Yes, y'all.
Starts off with this abstract summary, right? Manufacturing output at an all-time high. However, manufacturing employment is at a post-industrialization low. Why is that? Deregulation, dollar devaluation, and protectionist, isolationist policies will not resurrect manufacturing employment as most people think it will. Now, from The Economist, in the early post-war decades, the American economy grew at a healthy clip. Now, a clip is just a really cool way of saying the growth rate. I love saying healthy clip. We got a healthy clip there. It's a cool way, a little economist thing. Anyways, the American economy grew at a healthy clip. Millions of Americans earned a middle-class wage by working in manufacturing. In recent decades, rising inequality and stagnation, which we'll get to later in this podcast, of middle-class earnings have generated a wave of nostalgia for post-war economy and for manufacturing employment in particular. If only America hadn't lost its manufacturing edge, all would be well. Well, false. You might reasonably guess that manufacturing in the U.S. is in a secular downtrend. However, it's not. Real output is at an all-time high, otherwise known, here's another cool little abbreviation here, ATH, all-time high. If you hear someone say, yeah, we're at a new ATH, all-time high, baby, all-time high, it has nearly doubled in the past 30 years when we're talking about output. However, guess what? The amount of employment has dropped in half, and it peaked in 1979, and since then, it's about half those levels since the peak. So we're producing more than we ever had, and we have half the employment that we used to previously had. Very interesting. Check out these charts. If you want to see the charts, you're going to have to go to YouTube and subscribe. Leave a comment. How about a thumbs up? I'd appreciate it if you did, and we could be best friends. I'll see you there. All right, so increasing global trade is not the primary culprit of the decline of manufacturing employment. Guess what? Technology is the culprit that's increasing productivity. Employees needed to take the same output is more than halved in the past 30 years. Check this out. Bear in mind, we've got more and more complex assembly lines, right, that are taking these crazy machines and putting together cars and 3D printing homes and doing all this radical stuff that we couldn't have imagined. I mean, if we look back 30 years from now, people say that's science fiction stuff. Now some of the stuff we're imagining now, people are saying that's science fiction stuff, but I bet you most of it will become real. Let's look at Back to the Future 2. Came out in, 1988, 1989? You want to fact check me? Oh, it's around that time. He's going to get on a smartphone, which is crazy. You know, the smartphone today is 1,000,000 times more powerful, 1,000,000 times cheaper, and 1,000 times more powerful, 1,000,000 times cheaper, and 1,000,000 times smaller than the computer at MIT in 1966. Side fact, don't have that written down off the top of my head. That was a quote from Ray Kurzweil, basically the godfather of AI. Anyways, so bear in mind, complex products. Increasing productivity is stunning when you look at it within the same industries. For instance, another reference point from the Fat Pitch with a P, take steel production. In the 50s, it took 5,000 workers, 5,000 workers to produce the same tonnage of steel that today can be produced with just 400 workers. We talked about employment being halved. Well, in the steel industry, that's way more dramatic than half. Coal's another great example. Check out this chart. Today, employment in coal mining today is about at 60,000 workers, and that's less than 1/3 of the levels it was 30 years ago. However, output is about the same, having reached its all-time high recently as 2008. Look at this U.S. quarterly production of coal. It's steadily on the incline. It has some drops off in some year, particularly Q1 of 2016. However, it's been on a solid increase when employment is on the solid decline. The U.S. economy is no longer driven by manufacturing jobs. People, in 1953, more than 30% of the total U.S. economy, U.S. economy, let's just use that word a lot, was employed by manufacturing. Today, those levels are at 8%, and they're dropping every single day. Now, the downtrend, there's no amount of deregulation, dollar devaluation, protectionist, isolationist policies that will resurrect employment in manufacturing industry, as The Economist summarizes in this quote. The manufacturing employment downtrend predates the end of Bretton Woods. It predates the union question deregulating era of the late 1970s and early 80s. This is my quotation voice. It predates the era of Japanese dominance, the rise of the Asian tigers, which I'm assuming is like a generation, not like actual tigers. That would be really scary. I didn't know that they had a rise in tiger leadership. It's freaky. I think that was in Kung Fu Panda. And the recent surge in Chinese growth, a plunging dollar, a get tough approach to China, and an embrace of industrial policy won't do jack squat. Or wait, no, it won't reverse this trend. Sorry, I read that wrong. The technology will continue to make jobs obsolete. Truck driver is now the most common job in America. Let's bring up this chart. Check it out. Whew. That's my sound. Oh, my stomach rumbled. It's lunchtime, people. Look at this chart. Most common job in America, truck driver. I see some other colors here. School teacher, retail clerk, customer service, and random industries. Hey, would you look at that? North Dakota, South Dakota. Most common job's a farmer. Would have never guessed that one. New York, let's see. Nursing aide. These are just the one-offs. Everything else that you see in that what color blue is that? Can I get a color coding from you guys? It's the lighter blue. I don't think it's royal. I'm gonna go with a fuchsia. No, that's not blue. I don't know. You can talk out loud, Nick. It's okay. We all know you're there. All right, let's move on into the next portion. Since we talked about employment dropping off, I thought it would be natural to get into an income shuffle. So can we do the income shuffle? All right, we changed. Don't laugh at me because I'm corny. You guys, you're corny. How am I supposed to talk about finance without being corny? Come on. All right. I don't have a reference here for where this article came from, but I know who it was written by, and I'm going to make the link apparent in the description as well as on the website in the show notes, financialtimetraveler.com, or if you're listening on iTunes, Stitcher, wherever, you're going to see it in the show notes as well as if in the description of the YouTube video. But Jeff D, we're going to call him Jeff D, wrote a really cool article that basically breaks down the money that the average American worker makes. Now, usually we use a medium or a mean, but that when we use the average, it doesn't really tell us who's on the outskirts. Where are these people that are on the fringes? Because those are millions of people, and we're talking about the entirety of America. And so this awesome dude, his name's Nathan Yao, has created an interactive chart, which will be in that link, that breaks down millions of data points, and they're just 50 dots per industry. The dots are visualized on a scale of $0 to $200,000 plus dollars in income, and bind by $5,000 increments. So each of those dots, $5,000. Moving out. All right, the data is also adjusted for inflation, which is important. I know some people in the comment section don't like to adjust for inflation. Hey, some 401k calculators don't adjust for inflation. How crazy is that? How am I supposed to calculate out what I need in 30 years if you're not going to adjust for inflation? Make sure you're using the right tools, people. All about the right tools. All right, so let's move into it. Here's a snapshot of income distribution and what it looked like 57 years ago in a variety of broad industries. Let's check it out. So we're going from legal, management, healthcare practitioners, blah, 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 all the way down to farming and forestry, which makes the least amount of money. Surprise, lawyers make the most amount of money. It's probably why there's all these lawyer jokes out there. Everybody hates lawyers because they've been the richest for the longest. All right, so generally speaking, many of the ranges are on the lower side. They're very consolidated and close together. and tend to have data points clustered around the middle of each distribution, right? So let's fast forward to 2014. Jump in my time machine. Let's go. Whoop, whoop. Is that a new sound effect? Whoop, 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 whoop. All right, as you can see, in many of these professions, workers are now making more money. The spread is huge. However, that is good news for the economy. The downside, two problems. Higher inequality. So when we look at these data points and we include the lowest and the highest, we see that there's a significant amount of people that are on the right-hand side, and then we see a significant amount of people that are on the bottom side of the same industry. There are people making $10,000 in legal. I don't know what they're doing. Maybe they're a paralegal, but there's also people that are making $200,000 plus. Same thing in management. Literally every single industry except for architect and engineering, which is kind of cool, has somebody making $10K or less. Now it really gets consolidated when we look down into once we get down to military, cleaning and maintenance, healthcare support, food preparation, personal care, and farming and forestry. However, workers in those industries that might not be so lucky, those are mostly new jobs and entry-level jobs. So they're probably starting there and working their way up, not murking their way up the workforce. That'd be like assassination. I mean, that's one way to get ahead. But hopefully they're working their way up into higher management positions or just being more ambitious with life. Those are my kind of people. Those are entrepreneurs. That's the growth mindset. If you have that mindset, you're in the right spot. Let's grow our wealth together at a faster rate. And this is going to move us into the next section of, we're talking about people who have been employed. Now let's talking about people who are employed that are saving money. Where are they saving money? Well, let's talk about 401 what's up, or as they say in Espanol, 401 Que Pasa. All right. Ladies and gentlemen, if the balance in your 401k retirement plan is more than $92,500, you can take a victory lap, my friends, because you are above the average. And there's nothing like being above the average, you know what I mean? Now that balance makes a record in Fidelity Investments quarterly analysis. So they looked across 22,100 401k plans, defined benefit contribution plans as they call them, and 14.5 million participants, so a significant amount. I mean, there's over 250 million Americans out there. They looked at 14.5 million. It's a gain of about $4,300, or about 5% year over year, which is a significant jump. However, the S&P jumped 11.9% last year. So I'm curious because I looked in these numbers and they wouldn't break down how much of that money was just people making contributions, or, I mean, did you increase your contributions? Just 5% gain? That seems kind of normal, but they're pitching, it's the highest average account balance that we've seen. And then how much of that was the employer making contributions as well? We don't know, but I'm just here to report the facts. All right. Now, the difference between the average account balance by gender is super striking. So the average for men, $108,200. For women, $73,700. That's 32%. Now, the average balance for workers who stuck around their jobs for 10 years plus, shout out to you, y'all loyal.
You're loyal. You're grateful. I appreciate that. Go buy your mama a house. Go buy your whole family houses. Put this money in your savings account. Go spend some money for no reason.
All right, so anyways, for people who stuck around for 10 plus years, those loyal ones, the discrepancy between men and women is almost at 30% as well. For men, that average balance is $277,800. They're probably getting some profit sharing money. Women, $201,000, so 28% less, still there. Auto escalation is something that we have discussed in behavioral economic stuff. I believe I discussed it in my last podcast, which was described as cars misbehaving in the highway to building wealth. I talked about behavioral economics and some of the factors that are at play there. We're talking about automatic enrollment, automatic contribution escalation, default funds. All are symptoms of behavioral economic theory making its way into the defined contribution space, or the 401k space. Sorry if I'm getting ahead of myself here. But it was interesting that, let me see here. More than 1 in 4 people raised the percentage that they deferred into their 401k. So 1 in 4 people raised the amount that they're taking out of their paycheck to save towards retirement. Half of those people did so through auto escalation, right? So 1 in 8 people did it without even thinking about it. which is amazing. The more people we get in line, I think we'll start to see these numbers go up, and we can start to get America back to a healthy spot that when people retire, they can feel comfortable and not surrounded by fear and anxiety that are they going to make it if they retire as they get older and older, because people are living longer and longer. The good news is our life expectancy is getting longer and longer as we have these more efficiencies in technology. The bad news is we're living longer and longer, and it costs more and more money to be able to take care of ourselves once we get past those certain years. So very interesting. To see these account balance get higher is great. Obviously, this last rally that we had in the equities market last year, or the Q4 last year, moving forward into Q1, has helped these accounts move forward. If you had bonds though and you're a conservative investor, you probably got hammered in the last category, which is why that's only a 5% gain, even though the S&P gained 11.9% on the 1 year for 2016. People are more diversified than that. Some people at the beginning of their working career are going to be growth oriented, very aggressive. People at the end of their career, capital preservation, don't lose my money, essentially. They're going to be much more protected. Lower yields, lowered standard deviation, lower alpha, higher, lower beta, all the way across the board. You want to talk about this stuff. If you're a client at Up Capital Management, you got my phone number. If you're a Financial Time Traveler, just send me an email, Nyle at Financial Time Traveler. That's with a Y. It's like Kyle with an N, but way cooler. Shout out to Kyle. Anyways, I don't need that paper either. Let's move on to the next section, which is called How You Feel, How You Really, Really Feel. 25 sitting on. Okay, guys, this is about consumer sentiment. We reported on this in a couple podcasts ago when I had Anton on the show. He was sitting right around here. Unfortunately, he's a very busy guy. He makes a lot of money. He takes care of multiple companies. He's a CEO of like 17 million companies, and they all are like billion-dollar companies. So he's just killing it. He can't make it onto every show, but he'll be here when we need the expert to talk about how we're doing, our flex and our CFP, and all those other initials after his last name. So let's move on. The University of Michigan Consumer Sentiment Index for February was down to 95.7%, or 95.7, it's the index, it's not a percentile, from 98.5 in January. So the confidence reached a peak recording in January. We see the decline, although it remains quite favorable. So to be in the 90s is incredible. We're still very positive. It just declined from one of the most all-time highs. There's only 5 higher readings in the past decade. Here's where it gets interesting. They ask people how they felt about the economy and tell me why you feel a certain way. If you're negative, why do you feel that way? If you're positive, why do you feel that way? They move their gloves and they say, you tell me something without being prompted, without any subconscious bias of the caller. Just speak your mind. 30% spontaneously mentioned favorable aspect of Trump's policies. The other 30% mention unfavorable or negative mention of government policy. So we have 6 out of 10 people in these surveys that have either feel some type of way about Trump policies, and that's what they're directly mentioning when they're talking about consumer sentiment in the economy. Having said that, when I look at it as an financial advisor at Up Capital Management, a registered fee-only investment advisor, I'm thinking, okay, how accurate are these? If we're investing based on consumer sentiment, I don't like the fact that 60% of these numbers are coming from people that are speculating off a guy who just got into office, hasn't really done much, although he's getting there, he's starting to affect things, but it's still, the market is not really taking him seriously. When he had that Nordstrom thing with his daughter, Nordstrom stock didn't really move. So it's interesting to see that go into this consumer sentiment index. Now, we'll bring up the chart. You check it out, look at it on the blog, or if you're on YouTube, you already know what the deal is. If you're listening on the audio on your way to work, it's basically just a bunch of numbers. I mean, it's a bunch of lines. Let's be real. Now, I described it very well. I'm very articulate and illustrative with my vernacular. So let's move on into the credit score triple-double. I don't know if I'm on like the Price is Right with that triple-double line, or if it's like a Sports Center, LeBron James. I'm like LeBron James with a credit score. So Farnoosh Jarabe, you might have heard of her. She's like the personal finance guru. She went to Harvard, did a bunch of things. Hasn't managed money ever, but she knows a lot about finance, and she's been on CNBC. She's got her own show where she follows around some cool CEOs. You should check it out. I like it. I love seeing women in finance that are empowering, because like I said, there's that discrepancy earlier in the amount of money that women are saving. And they need a peer in there that's like holding it down, and that's why I love Farnoosh. Anyway, so she wrote a cool article for Mint.com. Mint's that app that I've recommended. I wrote an article about, sorry, I keep getting off. I wrote an article about my 5 favorite finance apps that you can check out on the blog. If you don't have one of these on your phone, you're slipping, fam. You're missing out. These are important to have. Check it out on the blog. Just hit the search button. It's in the archives. Anyway, so let's go through some of the numbers. You can have a credit score anywhere between 300 and 850. If you have below a 300, I don't even know what you're doing right now. Like, did you not put your name on the application? Does FICO just not know who you are? Are you like made from... anyways. So 760 or higher, you're an A+. I mean, I don't even really need to talk to you. Like, what are you doing here? Go and rent a yacht for free. I mean, what you could get probably a spaceship from SpaceX or something like that, and they'll be like, yeah, we'll give it to you at like 1% interest rate because you're killing it on. Look at this FICO score. You're amazing. Who's this FICO guy on your pay stub? Because he loves you. Anyways, you already know the deal. You've taken care of yourself. Nobody accidentally has a 760 or higher. I mean, no, don't even tell me because the whole room's going to look at you and hate you immediately. All right, let's go into the normal American, probably in the 660 to 760 range. I'm in here. I'm not gonna lie, I think I'm closer to like the 730. I've been working on it for years. I made some mistakes in college. I went all out. I bought a bunch of music equipment that I had no interest. I didn't know what I was doing, and I chopped up my credit card thinking I'm never gonna do this again. And I had a zero balance, and they closed my credit card, and then my credit history went down the drain. Anyways, I'm building it back up. If you're in 660 to 760, you're just short of excellent. When it comes to managing your credit, you're doing it well. Payment history, debt to credit ratio takes up about 2 biggest factors your credit score. So paying a bill late recently, a tall balance on your credit cards may cost you, might have a little bit higher of interest rate, but interest rates are so low right now and compressed, you're probably going to get, excuse me, I'm about to sneeze. Nope, didn't sneeze. Anyways, you're about to get probably, you know, you should be in the 2 to 3% on an auto loan. If you're getting a house, you should be in the 3 to 4% range, etc., etc. So, moving down the list, 600 to 659. We get a from Farnoosh. Can we get a She give us a Did you recently foreclose on your home? Are you delinquent on some bills? Delinquent. Sounds so bad. I feel like I'm in juvenile hall when she says that. At this level, your score suggests you're going through some tough credit times, or at least recovering from some recent setbacks. Fair enough, Farnoosh. Fair enough. You may qualify for a new credit card, but likely come attached with a higher interest rate. Another interesting point that she mentioned here at the top of the article was that, and I've heard this more and more of maybe I'm just getting old, but my friends, when they're dating, they're getting serious. Marriage is something that's happening more and more in the wedding season. When they meet someone, they want to get serious, they're actually checking each other's credit scores. They're coming to me and ask, how can I check this person's credit score on creditkarma.com or something like that, because it shows them how responsible this person is with their money. If you're not responsible with your money, you're probably not responsible in life. If you care about your money and you are responsible about it, you probably are, care about your life. You care about everything. And so it's a good indicator. It's not always solid. People make mistakes. Some people are better in certain areas of their life than others, but it might just give you a good understanding of where that person is and whether or not you're going to be able to finance a home together or a car, etc., etc. Anyways, 600 to 659, you're going to have a dinger of an interest rate. Maybe look at some ways that you can shave it down. Talk to a credit consultant. Shave down some of your credit. It might be something simple that could help you boost a few points. I've done that myself. Paid down a couple credit cards. Boom. Credit score went up here. Financed my home. Ready to go. Killed it. I'm at 2.5% because of that. It was a different time though. It was the best of times. It was the worst of times. Below 600, I'd lay low and don't apply for any new credit until you tack on at least 50 points, she says. If you're getting over a bankruptcy or foreclosure, it may take 7 to 10 years for those stains to fall off your credit. So just kick it for a minute. Put your feet up, work on your credit, get back into shape, figure it out. Take some time to regroup and think about your goals for the next 7 to 10 years. How are you going to achieve them? And work slowly. Just because you messed up doesn't mean you can't get right back. That's the whole purpose of life. I think the story of risk has to do with that there's a probability of more things happening than actually will happen. When mistakes happen, that's natural to the risk environment of life. So if you made some mistakes, totally cool. Let's just take some time to build it up. If you have any questions on how to do that, reach out to me directly. I'll help you brainstorm on some small ways. One cool way that she recommends is take on a secure card, which is like a credit card on training wheels. So you put your money in, you use it like a credit card, you pay yourself back, but it builds your credit score so that these most people, when you go and apply for something, you at least have a payment history. You have a debt to ratio balance that's, like we said, half of the criteria, and now you have that history to be able to say, okay, let's move up my FICO score. Come on, Mr. FICO man. And hopefully he does so. Anyway, some interesting stuff there. If you have any questions, let me know. Let's move on to the last section, which I call tax money. That payday, is it? Yeah, it's your money back to you. Anyways, let's talk about tax money. I saw an interesting infographic here, which will be up on the screen. Whoop, whoop. Everybody, infographics are so cool. They're like clean rooms. They're not like incredibly amazing, but they're oddly satisfying. You know, like those YouTube videos and stuff that it's just oddly satisfying, but not that cool. Anyways, this infographic breaks down saving versus spending when you're getting that tax refund. They're using 2015 data. Everybody's filing 2016 numbers. We don't have that yet. We're not in the future, although I might be. You never know. I am only 43 years old. So refunds in 2015, average refund $2,815. 2 in 3 people expect refunds. You think they're saving it or are they spending it? Gas prices dipped last year as well. I think the average household saved $1,400 on gas prices. Did they spend that money in other areas or did they save it? This is where it's kind of hilarious. Younger people, 18 to 24, are most likely to save their money than everyone else. Isn't that amazing? Isn't that amazing? Shout out to you millennials. I don't even think those are millennials. You might be millennials. Anyways, what's below a millennial? We forget. We don't even acknowledge your guys' existence yet. Anyways, I think that's amazing that we get a bad rep for not being able to save and be responsible with our money. But in this survey, they found that most young people are actually more likely to save than their higher cohorts. So smart spending, 39% are ready to pay down debt. You're the smart people. All right, 26.1% are using it for like everyday expenses. 13% vacation. You know what I'm saying? All right, 10%, they're doing a major purchase. So this is like a car, a house, and they put TV. How are you going to put car, house, TV? Is that the order of major purchases? What happened to horses? All right, maybe you're going to buy a horse, which is probably much more expensive than a car at this point. 10% are going to go splurge. So these are the people that are going to be broke when you're old. I mean, let's be real. You're splurging your tax money? Come on, man. Let's do something more responsible with it. Let's make that money make money. Let's take that money and put it on top of money. Let's stack. Let's build. Let's grow. Let's become time travelers with our wealth. Most people, though, are rushing for their refund either way, which makes me curious about the authenticity of what these people are saying. Because if you're going to save it, then why are you so anxious to get it? Anyway, so February accounts for almost 60% of everybody who files and gets their tax refund. Maybe they're just efficient. Maybe they got nothing to do. I haven't done my taxes yet because I'm waiting for all these things to come in so I can figure out what I can deduct. I'm probably going to do another podcast on tax deductions you might not know about. I think that would be kind of cool since we're in tax season. But that's going to wrap it up for today. If you have any questions or comments, let me know. I do have a free gift for you. If you want to go to financialtimetraveler.com/PDF, enter your name and email, and right there you're going to be able to download a list of my favorite free financial resources that will help you achieve your goals at a faster rate. Now, Abe Lincoln used to say that he would sharpen his axe for an hour in the morning to save him 6 hours of labor during the day. What he was referencing was time compression. Time travel, all right? Using efficiency. That's the same thing I want to deliver to you. I get hit up by all these organizations, whether when I'm at Up Capital, whether I'm at Financial Time Traveler, they want me to demo their fintech so I can deliver to you my favorites. I made a list of 5. It's at financialtimetraveler.com/PDF. All right, everyone. Well, I'll see you next time. Thank you for listening to episode 19 of the Financial Time Travelers podcast, Common Misconceptions. And remember that decisions today change mañanas. Was that one take? That was one take. All right, everybody, let's get right into the nitty-gritty. Let's get into the real stuff, the stuff that everybody wants to talk about, why we have notifications going on in the background, because it's chaotic in the background, because there's a lot of correlation. Nyle Bear from Financial Time Traveler, here to give you a response video to all the comments we got for episode 17 of the Financial Time Travelers podcast. That podcast was titled, Gold is the Worst Investment Ever, and this is the response to the comments that we received on Facebook.
10, Ignition sequence start. 6, 5, 4, 3, 2, 1.
The Eagle has landed. Roger, we copy you.